Personally involved with the U.S. financial industry. He's the creator and owner of Straight Money Analysis. That's straightmoneyanalysis.com. And he puts out a newsletter every quarter. He breaks everything down. He tells you what is happening, what he thinks is going to happen, and it's very informative. And I am very happy to have Joseph on the X22 Report Spotlight. Joseph, welcome back to the Spotlight.
Good morning, Dave. Thank you and the X22 Report for the opportunity to visit once again with your listening audience. It's a pleasure to be here. Thank you so much, Dave.
Well, thank you for coming back on, and we have quite a bit to talk about. And I wanted to start out with the European banks.
Okay.
And I just wanted to get your take on what is happening out there. We see German banks, Italian banks, Spanish banks. It looks like they're all in trouble. And we see there's a major problem. What is your view on what's going on out in Europe?
Well, I'm not surprised, quite honestly, with what's unfolding coming out of Europe. As you know, this problem's been building for a number of years. I question moving forward how much more the European Union and or the IMF can do. I think we're going to see a worsening of the crisis coming out of Europe. I think certainly as we move forward, the central banks of the world are going to once again continue to be very accommodative. I don't think certainly what we're witnessing here in the U.S. with higher interest rates is going to help the ongoing situation as it unfolds in Europe. And quite honestly, I think we're at a turning point with what we're witnessing in these global bond markets. Honestly, I think we're looking at some very troubled times coming out of Europe, certainly as we move into 2017 and beyond.
Now, people say that we should look at the bond market. When you look at the bond market, do you see problems in the bond market?
Well, I think the 35-year bull market, in my humble opinion, is over and done. And I think the question is not if rates continue to go up. I think the question is how quickly they go up and how far they go up. I believe the Fed, and again, this is one man's opinion, was behind the curve in what they were doing with interest rates. Honestly, I think interest rates in the U.S. should have been raised about a year ago. But I think looking at what has unfolded, certainly in the fourth quarter here in the U.S. with very weak retail sales and certainly the consumer on balance certainly pulling back, I'm questioning now as we move forward whether the Fed will go ahead and raise interest rates additionally in 2017. I have my doubts now, Dave.
So you don't think that, I think they came out and they said they were going to raise interest rates like 3 or 4 times during 2017. I think they said they were going to do this in 2016, like maybe 3 times or so, but they waited until December. All the data that's coming out from the U.S. government and from the Fed, it looks like the economy is doing fantastic according to them. When you look at the economy, what do you see?
Well, I see the economy continuing to deteriorate. I think Christmas sales on balance were very, very disappointing. I think the job market remains very uncertain. And I think at this point, people are questioning whether or not the president-elect coming into office can accomplish the things he's outlined that he wants to do. You know, honestly, I think it's not going to be as smooth sailing moving forward with a lot of changes that certainly the president-elect is going to be wanting to make. I think we're going to see some resistance along the way. So in the short term, I'm very cautious, but in the long term, I'm very optimistic.
Now, we're continually seeing the stock market continually move up. It's bouncing around right now, but it's very close to 20,000 points.
Yes.
Do you see the stock market as a gauge of how the economy is doing, or are they completely separate?
Well, I think they're completely separate. I don't think the market now for many years has been really truly reflective of what's going on within the U.S. economy. The biggest concern I have with what's going on in the U.S. equity markets currently is simply the other world markets are not confirming what's happening here in the U.S. Let me give you a couple examples, Dave. China's 47 below its 2007 high. Japan is about 51% below its 1989 high. Italy currently about 60% below its 2007 high. And lastly and importantly, the U.S. is now about 70% above its 1999 high. So what we're seeing here in the U.S., which is concerning to me, is the strength in the U.S. equity markets not being confirmed by these other global markets. I think that's a major warning. We could be headed for some problems, Dave.
Now, you've been in the financial industry for a very long time, going all the way back to the 70s. And you were around when we had the Dow hit, I think it was 1,000 points for the very first time. Now, when you saw this happen and you were in the financial industry, what was the feeling like when the Dow finally hit 1,000 points? I mean, what was the mood?
Well, when it hit 1,000 the first time, as you know, in 1966, and the second time was in 1968, and it failed both times to stay above 1,000. And as you know, it took 17 years until 1983 till the Dow finally closed above 1,000 and was able to remain above it. So to answer your question, what was the thinking going back in 1966? People looked at 1,000 and the word on the street was it was simply a graveyard in the sky. I don't know if you remember that, but that's what they called it.
Now, what happened after, I think it finally hit 1,000, and did people think it was going to go much, much higher, like it was going to go to 2,000, 3,000? Because... Well,
I think people were confident that once it got above 1,000, it would remain above it, but we had so many problems that were going on simultaneously. As you know, we had the early beginnings of the Vietnam War, and it was very, very costly. We also had the spending programs on the Great Society, and corporations were having difficulty being profitable, and there were a lot of social issues which were going on along with a lot of political problems, and the markets just were unable to remain above the levels that people had believed that they would. That's what happened, as to my memory of it.
Yeah, and I think after it hit 1,000 points, I think 9 months later, the U.S. entered a recession where the market...
Yes, it did.
It came down like 44% or something.
The second time we got above 1,000, and I was a young broker in the markets going back 1972. Nixon won re-election, and I think the market traded to 1,051. But 18 months later, the bear market had ravished the equity markets, and the Dow had fallen down by May 1974 to 570. I remember that day, Dave, believe it or not, like it was yesterday.
If we take what we saw back then and we bring it up today, because every time I look back, I notice the market reaches like all-time new highs, and then all of a sudden, the bottom drops out from under it. And I feel like we're at this all-time new high. Now, there are people calling for 100,000 stock market. Do you see that at all?
Well, you know, I think, first of all, you got to put in perspective, and people have a short memory, where this current rally in the equity market began. You got to go back to March 2009, Dow level 6470, S&P 500 670. So you've had a 13,000 point plus advance in the Dow and a very huge move in the S&P 500. We've never had a meaningful 20% or greater correction all through this bull move. And honestly, I think this bull market is looking quite tired, and I'd be using any further strength in which to raise some cash and certainly move to the sidelines, because I think the upside is limited and the downside is great. You know, having said that, how far can this market correct? I think it can correct a lot more than people want to believe. And I think even if we were to trade back above 20,000, which is a possibility, I don't think at this point the economics of the underpinnings of this market would certainly indicate that we can stay above 20,000, not just right now, Dave.
You talked about the economics, and I wanted to talk about the economy of the country, not the stock market. But when you look at the economy, when I'm talking about employment, I'm looking at the quality of jobs. I'm talking about the retail sales that you mentioned in the beginning of the interview. I'm talking about corporate profits. When you look at all this, do you see a strong economy? Because Obama is out there, and of course we know he's leaving office. He's telling us how great the economy is doing. Do you see a strong economy now, or do you see major problems?
I see major problems moving forward. I think we've got inflation probably right around 10% a year, and I think we've got true unemployment probably in excess of 20%. the quality of jobs was creating are still very poor. They're minimum wage, no benefit, part-time jobs. There's no way you could support a family on them. As far as corporate profits, I think they've peaked out, and I think corporations are going to start cutting back. We're already seeing the layoffs, and I don't rule out that at some point in 2017 the economy falls into recession, Dave. I really don't.
You know, it's very interesting. You said something about layoffs, and I know two people that I know personally that were laid, and they live in completely different parts of the country. One lives up in New York and worked on Wall Street, and I know someone that worked in Florida, and they both got laid off. They had no idea that this was coming, and they're just shocked of what just happened. And they've been telling me that, you know, they've been putting out their resume, and they're really getting no responses back.
I'm not surprised.
You're not surprised at this. What's your take on the job market?
I'm not surprised.
You're not surprised at this. What's your take on the job market?
Well, I think it's a tough job market. I think companies are being very selective, and they're certainly hiring the highest quality, most capable people that they can find. But there's pressure on wages, and I think the opportunities are quite limited. And I think Wall Street is certainly looking towards some tough times. And it's been a hell of a run. You know, we've seen record profits over the years, and to believe that they can continue inevitably forever, you know, is wishful thinking. We're long overdue for an economic contraction. We're long overdue for a slowdown and/or recession. And I think the Fed now, you know, questioning what they're going to do additionally with interest rates as we move forward is another question mark here. Corporate America at this point is very concerned with.
So the corporate media is out there, and they continually, you know, are pushing Trump euphoria that, oh, look, everything is just moving up. Everything looks fantastic. Is what we're seeing, does this really have anything to do with Trump?
Well, I think when you look at the big picture, you know, three immediate concerns I have when we talk about the equity markets are, quite frankly, Dave, they're extremely overvalued, they're widely overextended, and they're still at this point rampantly euphoric. But through my long career on Wall Street, I've seen stock markets, as I'm sure you'll agree, go through four phases. They're the four phases of a bull market. They're born on pessimism, they grow on skepticism, they mature on optimism, and then they finally die on euphoria. Could we be witnessing the end of this long bull market that started in March 2009? I think it's a real possibility, and we can't rule it out. I think this market could be setting up simply for some great disappointment to the majority of investors that refuse to see the reality that this bull market could finally be over. I think the greatest risk moving forward, as you know, is when we talk about retirement assets. We got $23 trillion in retirement assets, but of that $23 trillion, we have approximately $7.3 trillion in IRA accounts. So I think you got people taking risk in their 401k and in their IRA accounts that they don't really understand what is going on in these markets and the risk they're taking with their retirement hard-earned dollars.
I mean, how big is the risk for pensions right now?
Well, I think the risk is very great because, as you know, the majority of pension funds are underfunded, and I think the problem is they've locked into a rate of return which is unrealistic that these markets can certainly not give them. And I think at some point we're going to see a lot of money fleeing the stock and bond markets, and we've got people now convinced the economy is strong and these markets can grow to the sky. And I think, quite honestly, we have the scenario that's been set up now for great disappointment. One man's opinion. I could be wrong, but I don't think so.
So you're saying that money is going to flee from the bond market, the stock market. Where is all this money going to go?
Well, I think it's going to certainly go to the sidelines. It's going to stay in cash. I think a portion of it will work its way into the precious metals as gold and silver move inevitably higher. And I think people are going to wait till they certainly can see much more clearly exactly what this economy has on its mind that it wants to do.
Do you see any triggers that could cause the bear market? Do you see anything out there that could just bring everything down?
Well, I think when you talk about honestly what's going on in the U.S., as you know, the financial sector and the banks have had a huge move. I think if we see any surprises coming out of the banking sector, coming out of the financials, an awful lot of good news has certainly been priced into the performance of these sectors of the market. So I don't think it's going to take much negative news to start this market down. It's not a question of if, it's a question of when the negative news comes in and affects the market and people's psychology as to whether or not they still want to be part of what they believe is going to continue to go on for a number of years.
Now, I just want to get back to the job market just for a second. It just popped into my head where Trump is out there and he is, telling everyone that he's bringing jobs back to America. And we see GM, we see Walmart, we see Ford all telling us that they're going to be building manufacturing plants. They're going to be bringing jobs back to here. Walmart is saying they're going to be creating 10,000 jobs. And on the other hand, we see stores closing like Macy's, The Limited. We see layoffs in retail. How can this possibly occur all at the same time?
I don't think it can, and I think that's the reality that most people have not been able to certainly accept and or want to believe. I think there's great disappointment ahead. Again, I come back to what I've said. The economy has been based on purported good news, not that I believe any of it. I think the stock market's totally detached from the economic reality and the underpinnings of what's been deteriorating, again, in my opinion, for a number of years. And I think there's great opportunity ahead, but I think there's great disappointment before we get there.
Do you see the market turning down this year?
Well, I think we could very well start a bear market again. The question is, how long does it last and how severe will it be? I think it makes sense to use any further strength in the stock and bond markets to raise some cash reserves and prepare for lower prices. I think people are waiting to see what happens with interest rates, what happens globally, certainly with this ongoing banking crisis. And quite honestly, I think everybody's going to exit the bond and stock markets all at the same time. I think they're going to finally realize that what they've been told is certainly far different than what is going on in the economies of the world in these various markets. And I think everybody's going to decide they no longer want to be part of the stock and bond market. And we're going to see a tremendous amount of selling and everybody trying to get through the door at the same time. And I think if we see further strength in the markets, and I believe possibly we could see that, it's an opportune time to certainly reduce your risk that you're taking in the market, raise some cash reserves, and wait for lower prices. That's the way I see it, Dave.
How far do you think the market is going to come down? First question. And how long do you think it's going to last?
Two great questions, Dave. I think, first of all, we could come down and certainly see the 2007 high in the Dow, 14,100. And if the bear market really gets rolling, then I think we could come down to the 2000 high, 11,780. But I think at a minimum, we're looking at a 15-20% correction, and chances are, as long as this bull market has lasted, and more importantly, how much it's gone up over the last several years, the percentage of decline could be even greater. But typically, bear markets, and you know this, they last 1/3 to 1/2 as long as the previous bull market. So we could be looking at a prolonged bear market that could very well spill over, if it starts in 2017, well into 2018. I think you couple that with, as you know, the first 2 years of a new presidential cycle are not usually overall very bullish. And I think you tie that in with what I recently researched when we looked at what happened when Ronald Reagan won the election in 1980. The Dow initially went up about 11%, and then when the rally was exhausted, we started a pretty sustainable bear market. Here with President-elect Trump, I believe at the peak we were up about 7.5%, 8%. And if we're going to see a similarity, which I'm not saying we will, but it's a possibility, this rally might have been the final move to the all-time highs that we witnessed in this bull market before we start a pretty severe economic recession into a bear market, Dave. I don't think you can rule it out.
So when this market comes down and we enter the bear market, what is going to happen with the actual economy, with jobs, with retail, with housing? And what do you think the Fed is going to do to try to prop everything up?
Well, I think the economy is going to first face the reality that the market was an illusion and that it was never really reflective of what was going on beneath the surface. I think we'll see the various sectors of the economy worsen, and I think the Fed will step up to the plate with QE4. What concerns me is, QE has really failed to turn the markets and, more importantly, turn the economy to the long-term positives that you would have thought would have worked hand in hand to bring a better lifestyle to the average American. I'm questioning whether any stimulus additionally, from the Fed will really make a difference at the end of the day.
Joe, thank you very much for being on the X22 Report Spotlight. I really appreciate it. And once again, how can people see your work?
Well, you go to the straightmoneyanalysis.com website. I have a full sample issue of the newsletter I write on the website. You can download and read it. I'm working as we speak on the next issue of my newsletter, which will be the March 2017 issue. And we send the newsletter out, as you know, quarterly. I send it out at the first of the month when the issue is due, and we send it out by email. And anyone wants to speak to me directly, they can always call. We're here certainly to answer questions any of your listening audience may have. And if anybody would like to email me, as you know, we answer all emails come in, and we'll certainly get back to your listening audience, and hopefully they'll enjoy my work and my perspective as to what I think is ahead in the market.
Joe, thank you very much for being on the Spotlight. And what I'm going to do is I'm going to put all the links at the bottom of the video, and this way it'll make it easier to go over to straightmoneyanalysis.com, and you can see his newsletter and sign up right on the site. Once again, thank you very much for being on the Spotlight.
Thank you, Dave, in the X22 Report. Always a pleasure to visit with you and your listening audience. Thank you so much, Dave.
Thank you.